Welcome to The Explainer. Today we're digging into a pretty provocative article. It basically asks a huge what if. What if a single executive order in, say, 2025 could totally flip the script on our retirement savings? We're talking about a fundamental challenge to the 401k system as we know it.
Right out of the gate, the author, Dara Albright, makes this really bold claim. She says that we've been sold a comforting fiction, that the whole retirement system we've been taught to trust, well, it might not be what it seems. Okay, let's get into what she means by that.
So what's this big illusion she's talking about? According to the article, the problem isn't just about how much money we're putting away. No, the core issue, she argues, is where our 401ks are legally required to put that money.
And this is where she introduces this term, dysfunctional markets. Her whole argument kind of hangs on this idea. The claim is that the public stock market has become so, well, concentrated and narrow that it's essentially locking everyday folks like us out of the investments where the real explosive growth is happening. Okay, so to back this up, the article throws out some pretty stark numbers. Let's take a look at the data she uses to argue that the system is, well, dysfunctional. First off, let's talk about concentration. The article points out that just 10 companies make up over a third of the S&P 500. Think about that. When your 401k is that top-heavy, is it really diversified? The argument here is, no way. The performance of your entire nest egg could be riding on the success or failure of just a handful of giants.
And get this concentration is happening in what the author calls a shrinking pond. Since about 1996, the number of companies you can even invest in on the stock market has been cut roughly in half. So you've got fewer and fewer options, but more and more money pouring in. The article argues that's a recipe for disaster, or at least for inflated prices and a shaky foundation.
And that leads to this absolutely massive number from the source, $40 trillion. That's trillion with a T. And a huge chunk of that is from our retirement funds, all chasing the same tiny group of stocks. I mean, the author's point is clear. This isn't just bad diversification. It's creating a super fragile system where everyone is crammed into the exact same boat. Okay, but here's the real kicker, the crucial point of the whole argument. The article claims the real game-changing growth, it happens before a company ever hits the stock market. The data it presents shows these early pre-IPO investors are the ones who see those incredible returns. By the time a company goes public, the party's kind of over, and public investors are just left with the scraps.
And she really drives this point home with a pretty sharp line, right? If you think that 60% beats 400%, then I have a bridge to sell you. The message is blunt. If your money is in a typical 401k, you are fundamentally missing out on where the real wealth is being created.
So, after painting this pretty grim picture of dysfunctional markets, the article pivots. It doesn't just leave us with the problem, it proposes what it calls a groundbreaking solution. This hypothetical executive order in 2025 that could just rewrite all the rules.
Now, to be clear, this is a thought experiment in the article. It's a hypothetical scenario. And it's not about the government creating some new retirement plan. It's all about redesigning the existing system by changing one simple thing, the rules of access. Who gets to invest in what and when.
So this hypothetical order would do three big things, according to the article. First, it would let our 401ks invest directly in things like private equity, the stuff that's usually off limits. Second, it would nudge the SEC to overhaul those accredited investor rules. The ones that basically say you have to be rich to get in on the best deals. And third, it would create a safe harbor for financial advisors, so they can actually recommend these new options without getting sued.
Okay, so what does this all mean for your bottom line, for your actual retirement account? Well, the article runs the numbers, comparing two different portfolios. And honestly, the difference it shows is pretty striking.
So on one hand, you've got your traditional 60-40 portfolio, 60% stocks, 40% bonds, pretty standard stuff. But then it compares that to a portfolio that's diversified with those alternative assets we were just talking about. And yeah, as you can see from the model they present, the potential difference in performance is, well, it's huge.
I mean, a 70% jump in average annual returns. That's what the model shows. When you're talking about saving for retirement over 20, 30, 40 years, that kind of difference isn't just monumental, it's life-changing. It could literally be the difference between a comfortable retirement and, well, not.
But here's what the author says is maybe the most important part. It's not just about chasing bigger returns. The model also shows a huge improvement in risk-adjusted performance. What does that mean? It basically means getting more bang for your buck. You're achieving those higher returns more smartly, more efficiently, without just piling on a bunch of crazy risk.
So the article wraps up by kind of painting this picture of where this could all lead.
It calls it a new retirement architecture for the average American. And what does that look like? It's a future where you, through your regular 401k, could have the same direct access to a whole range of assets. We're talking private companies, real estate, maybe even digital assets. The kind of stuff that up until now has pretty much been the exclusive playground for big institutions and the super wealthy.
So in the end, the author makes a really powerful case for a complete overhaul of how we think about retirement savings. But it leaves us with a really big, thought-provoking question, right? Is giving everyone access to these new kinds of investments the key to a better, more secure future? Or are we just opening the door to a bunch of new risks that most people aren't prepared for? It really gets you thinking about that constant tug of war between opportunity and safety in our financial future.